Hello, everyone, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session, Economic Update and Q&A for Commercial Real Estate. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's moderator, Kelvin Tetz, Partner and National Practice Leader for Real Estate here at Moss Adams. Kelvin?
Hello, everyone, and thank you for joining us today. As Amy mentioned, I'm Kelvin Tetz, Partner and National Practice Leader for Real Estate at Moss Adams. Today, I have the pleasure of moderating this session and introducing our guest, Ken Rosen. Ken is Chairman of Rosen Consulting Group, a real estate market research firm, Chairman of the Fisher Center for Real Estate and Urban Economics, and Professor Emeritus at California State Chair of Real Estate and Urban Economics at the Haas School of Business at University of California, Berkeley. Ken is a trustee of the Urban Land Institute and a board member of several nonprofit and for-profit entities. Before I turn it over to Ken, I'd like to kick us off with our first polling question. For those looking for CPE credit, obviously need to complete these questions. So please. Real easy one here. Check the box next to the selection, and we'll give it a second here to see how many of these we can get. So here we go. As a reminder, the presentation, the formal presentation, will last about 30 minutes or so, and then we have a substantial amount of room for Q&A at the end. So while we go through the presentation, please send your questions through the Q&A box, and we'll get to as many of those as we can at the end of the presentation. We'll give it, we're close, we're at 76%. Give it another second here. All right, and now I'd like to, and here's our results. And now I'd like to turn it over to Ken.
Thank you, Kelvin, and thank you, Moss Adams, for sponsoring this event. Our first slide, slide 5, is really saying that there's been major structural shifts that are occurring because of COVID, and there's structural shifts that were happening before COVID. Those trends some of those will continue. So we want to talk about those because COVID has upset the apple cart in many, many ways. I think the positive side is the vaccination miracle, that we basically have reopened the economy, and those who are vaccinated appear to be fairly well protected, and the virus appeared to be contained. Now, I say this, of course, we prepared the slides a while ago. The last 2 weeks have worried us a little bit. And the worry that we have and everyone else has is the Delta virus basically evading the vaccine, or is it being effective or not? So we'll have to say that the vaccine miracle has allowed us to reopen. Let's hope it continues for the foreseeable future. The government's response to this COVID crisis has been, first of all, when we started, we shut down the economy, trying to prevent the spread of the virus a year ago. And we passed a $2.5 trillion CARES Act, which was meant to provide medication, basically, for those who lost their jobs through unemployment compensation, enhanced unemployment compensation, PPP loans for smaller businesses, some large lending for airlines and others. And that was very important to keep the economy and people and industry from experiencing massive declines in income and other problems. In December of this past year, we did another $900 billion, which is basically an attempt to extend all those things we just mentioned. In March, another $1.9 trillion put in place, even though at that point it looked like the economy was getting better. And the proposals now going forward, there's an infrastructure plan proposal of $1.7 trillion. There's also a proposal of $1.5 trillion for the American Families Plan. And yesterday, the Senate Finance Committee proposed a $3.1 trillion basically American Families Plan, double what the Biden administration proposed. So this is a massive injection of money from the federal government, never seen before except during World War II. Again, a lot of it's happened already, but the additional proposals amount to almost $4 trillion if they were to happen. At the same time, we've had extreme monetary policy. And what that means is short-term interest rates have been kept close to zero now, and the Fed has said they're going to keep them that way through the middle of 2023. And the Federal Reserve balance sheet has expanded to $8 trillion from $1 trillion in 2007 and from $4.5 trillion in 2015. What this is the system is flooded and awash with money and liquidity. And that has been the response of the government. Pour money in, and of course the virus containment is really the issue. And if that successfully works, then we've got an economy that's stimulated by its reopening and this huge pile of cash. And I think one of the big risks that we think is there is the potential surge of inflation as we get the same thing happening worldwide, a simultaneous recovery. We've already seen signs of it. Yesterday's CPI was announced 5%, 5.4% up year over year. Now the Fed is claiming, and they said again this morning, this is all temporary due to reopening, but all this money is producing things like a 24% increase in house prices, like a stock market at super high levels. And so I very worry that we've got asset inflation responding to all this money. At the same time, we have a proposal from the Biden administration as part of the American Families Plan and part of the Senate Finance Plan as well, is a very large change in tax laws. We'll talk about that, which could affect real estate quite dramatically. Before COVID, we had an aging of the population in the U.S. and Western Europe and China and Japan, and that's going to continue. And that means we're going to have a lot less workers relative to retirees as we go forward. We also have seen an acceleration of the trend that was already happening. People leaving the high-cost, high-tax, high-density metropolitan areas on the coast of the U.S. and moving to lower cost, lower tax, and lower density locations. And we also see a sharp slowdown of international immigration. which accounts for 45% of all of our population growth. So these demographic trends were happening before COVID. COVID accelerated them, and I don't think they're going to reverse in a big way after COVID. And of course, the big debate everyone has is COVID. As we shut down the economy, we had large numbers of people on the white-collar industries work from home, remote work. And San Francisco and New York offices are still less than 25% occupied. In Florida and Texas, it's closer to 40 to 50% occupied. But the question is, has this changed people's desire to commute, to go to work, where they want to work, what type of work they want to do? And will this reduce their office footprint? Will it change the footprint in terms of what geography they're in? The surge in sublet space that's available makes us worry that maybe this is more than just a short-term shift, that the hybrid work model may mean less demand for office space. Of course, before COVID, we had a big shift towards e-commerce. That's continuing. It accelerated during COVID, but what it has done is, of course, spurred the demand for warehouses. And as I mentioned, there seems to be a resurgence in demand for single-family, for sale and for rent housing in suburban and mountain state and Sunbelt locations. So this is, again, I think partly response to COVID, but partly I think the millennials have begun to get married, have children, do all the things they delayed before this happened. The next slide talks about the potential tax law changes. And I think it's important that this is just potential at this point. But the Biden administration has proposed doubling capital gains taxes to 43.4% if you have over $1 million of income, and retroactive to April 28. They've also proposed to repeal the 1031 like-kind exchange, which has been very vital for individuals building their real estate fortune. You don't really pay any capital gains taxes if you exchange into another like-kind property. And they've also suggested they're going to repeal the step-up on basis at death of your asset value, which means that you're able to avoid the capital gains tax. Now you're, if this were to pass, you'd have to pay the capital gains tax. They're also suggesting to remove carried interest loophole, which allowed people to transfer ordinary income into capital gains income. The one positive might be they might lift the $10,000 limit on state and local income tax deductions from your federal taxes, which was put in place in 2017. But these potential changes would dramatically affect individual real estate investors if they were to happen. So the next slide just talks about the type of recovery we're in economically. And I call it a K-shaped recovery. There are certain sectors that have boomed during COVID and are still booming. The tech sector, the software, e-commerce retail, life sciences, suburban for sale and for rent housing, the home improvement industry, logistics, and anything online, streaming, really boomed. And as we've reopened the economy, the travel, entertainment, hospitality sectors are all recovering, but are ways from full recovery. Obviously, international travel, a long way from full recovery. And the CB coastal metropolitan office and apartment markets, well, the apartment markets are showing recovery, but certainly not there yet. And the office markets are still waiting for people to come back to the office. So the question are these adaptations to COVID temporary or permanent? So the type of recession we have, as slide 8 shows, is very different than the previous 3 big recessions. And that's my issue with the Fed's response, the Federal Reserve's response, and again, the federal government's deficit response. This is about the virus. And definitely we want to protect people as we shut down things to prevent the virus. But now as we reopened, we don't need all this stimulus. And they're very slow, and they removed it. They're actually planning to put more stimulus in. So this is a short V, you can see, coming back quickly. If we do contain the virus and the variations don't evade the vaccine, I think the recovery will be complete in another year, maybe 18 months at most. So a very short recession, very different than 2008 or 2001. So I think the federal response is very blunt, and to a K recession, blunt response is wrong. Slide 9 just shows you what I call is a pencil recession, the shutdown and then the reopening. And if you look at that box on the right, we did have another partial shutdown as we had the surge in the virus over the winter. We actually lost jobs and a very slow growth in December and January. But it is about the virus, and I think that is lost on some of our policymakers. And slide 10 shows you that labor market's in turmoil. Even though we have not recovered all the jobs we've lost because some sectors, like international travel, conventions, hospitality, are not back fully yet, we have the record level of job openings, higher than we've ever seen before. And there's basically the YOLO effect. You only live once. So people are shifting where they want to work, what they want to do. And so I think this is a very big element of change. We have almost 4 million people who have dropped out of the labor force permanently. And the Fed somehow thinks they're going to come back, but they're not. And it's possible they might, but we don't know. So people have changed what they're doing, where they want to live. And I think to think everything goes back the way it was after the virus is over, it's a little bit, I don't think is right. And we see this in slide 11. We've had a massive increase in outmigration. By the way, the outmigration was already happening from California and from New York, Illinois. It was already happening, but it doubled during COVID. So people have left net. These are domestic people leaving. And remember, what we had is international legal immigrants coming in to replace them before COVID. That has stopped under the Trump administration. They slowed it down dramatically, and it actually stopped in the last year. So this big outmigration is very important. And where are people going? Slide 12 shows you the Florida, Texas, the Carolinas, Arizona, Tennessee, low tax states, lower cost of housing states, more pro-business states. So it's important to say that the quality of life is perceived by many to be better in these states. We have the homeless issues, of course, and the surge in crime in many of our cities as well. So this preceded COVID. COVID accelerated it, but it was happening already. And just to show you, slide 13, where are the Californians going? And this, again, was before COVID. So the numbers doubled during COVID, but where were they going before? To the neighboring state of Texas. I laugh and say neighboring state, but the fact is Texas is a pro-business, quality of life, low cost of housing, no income tax state. But then they are going to neighboring states, which like Arizona, Nevada, Oregon, Washington, Colorado, Idaho, Utah. So the Californians, despite the governor's statement and a lot of these studies saying there's no exodus, it's just wrong. This is the official data from the census. We didn't notice it because the international immigration made up for it. California was growing. California has stopped growing because we don't have the international immigration. So slide 14 is just trying to summarize where the overall economy is. If you look at the bottom part of the chart, we had the shutdown in the second quarter of last year, and then a big revival in the third quarter. And we continue to see this happening in 2021 and 2022. We're going to get back to a 5% unemployment rate very soon. We're already at 5.9. And we're going to add back many of those jobs. And certainly we think once the full reopening happens, and this all assumes the virus remains contained, we don't get another surge, which scares us all, I think we're going to see the economy fully restored by the end of 2022. But the risks are there. Slide 15 really highlights these risks. And I think the biggest risk is the virus. And I keep on saying that, and I know you're tired of hearing those words, but the fourth wave of the virus in the last few weeks seems to be happening not only in vaccinated states, but unvaccinated places, but vaccinated places as well. And the key question is, will the vaccine protect us from serious disease, hospitalizations, and deaths? And I think we don't know yet. The latest data from some offshore locations indicate we may need a booster shot. Pfizer said so themselves this week. The CDC says no, but remember, the CDC said last February and March, a year ago, masks are useless. So don't trust what they say. They're political animals trying to do the best they can, but they're really been behind the curve. So I worry about this. I think we all need to worry about it. On the policy side, if we get the full snapback and the virus doesn't resurge, we've got too much money in the system. It's creating asset bubbles. Single-family housing is just one element of it. Stock market, another element. IPOs, SPACs. We have a huge surge in asset values, and that's what the Fed should be worried about. They should not think they can control CPI inflation, and they flooded the system with money. Again, the debt to GDP ratio has risen dramatically, and we're going to have to pay for this. I don't believe the theory that you can print money and run big deficits and it doesn't matter. That's the new economic theory that our progressive friends are portraying. That doesn't work. So we're going to have some big issues, especially if you put these tax increases in place. So when we normalize interest rates, it's going to be a very big burden on the economy. We're going to have no choice but to normalize. The market will do it with inflation picking up, whether it's 3 or 4 or 5%, and the asset inflation is going to come home to haunt us. At the same time, we have deglobalization. And this started with the trade war that we started with tariffs, but it really expanded to this Cold War we have, economic Cold War that we're talking about with China. We don't really have it yet, but we're talking about it. And I think that's a mistake. We've got to learn to coexist with China. It's a very dynamic place. Sure, they don't do everything by the rules that we do, but they've been not doing this for some time. And they're the second largest economy in the world. They're our manufacturing center. How we onshore those jobs back, how do we handle this? Very tricky and tough issues. And there's increasing, I think, risk of conflict worldwide. So I think that there are those risks out there. The biggest one is the virus. If we can get around that, then the flood of money. How do we normalize away and have a normal interest rate environment? So speaking of that, if we look to slide 16, we have a very abnormal interest rate environment. The green line shows the 3-month Treasury bill rate, and it shows it for the last basically 30 years. And we've had this downtrend, but basically it's averaged about 2 to 3%. And then following the Great Recession, we cut rates to 0 for 7 years. We were then normalizing, as I thought we should have a lot sooner, but we were normalizing 3 years ago. We got back to 2.25 on the short rate. I think we were going to 3. But with the onset of COVID, we cut rates again to close to 0. The 10-year bond, which is very important to finance in real estate and every company, has had a long downtrend from a 9% rate in the early time period. We got down to an average of a 4.5% rate. With the Great Recession, we pushed that down further. And more recently, we got below 60 basis points a year ago. At year end, it was 90 basis points. We've now moved up some. We got to 170 about 2.5 months ago. We're back to about 138 now. But there's no way we can keep a 10-year Treasury at this level as we have a 3+% inflation rate, even a 2% inflation rate. So we are going to change policy. And the slide 17 just shows you the Fed already has moved a little bit. In their June meeting, they and each of these dots represents a Federal Reserve board member or a head of a regional Fed. They moved their dots from where they were in March. So more people now are thinking they're going to increase rates in the middle of 2023 by about 50 basis points. And the green is the median. And it's a significant number. 7 people are thinking by 2022. If the recovery is as strong as it looks and continues and the virus doesn't surge back, I think the middle of 2022 is definitely when they are going to move, sooner than the market thinks. Also, look at the long run. Where should rates be if we didn't have the virus effects? 2.5% short rate, I think, is where people think they should be. So think of where normal is when you're thinking of your financing strategy. What that means is, though, if you can lock up these rates using capital market techniques or long-term borrowings, this is a unique opportunity to do that. Because long run, this isn't going to stay there. The repression can't, unless we have a continual surge of the virus and go back to a significant recession. But assuming we go back to some sort of normal growth pattern, rates can't remain at these levels. And the balance sheet, slide 18, again, shows you we flooded the system with money. During the Great Recession, we had QE1, QE2, QE3, and now, of course, during COVID, we've had QE4 to a level that's unseen before in history. And so the question is inflation. Slide 19 just shows you and it's actually a little bit outdated. We got some new inflation numbers the last couple of days. Inflation's above the Fed's targets. They claim it's because of COVID reopening, and it's somewhat true. We had a depressed price level a year ago, and so maybe 1 percentage points or maybe more because of the COVID reopening and the supply pipeline issues. But when house prices rise, as they have, when you see the bubble in assets, you know there's something else going on. So our view is inflation really is going to be 4% this year and remain above 3% going forward. Finally, the final issue or important issue is where are people going to work? So slide 20 just shows you employees want to work from home. 31% never want to come back to the office. Another 20% only 3 days or 4 days a week. 1 to 2 days a week in the office, 3 to 4 days a week at home. So employees love working at home. It gives them a lot more flexibility. All of that is somewhat true. Employers know it's better to be together. As slide 21 shows you. Employers, the blue line there, want people back in the office a minimum of 3 days a week. And I think that's where we're going when the massive reopening happens. And I think that happens after probably September 7th, after the summer is over, barring again a surge in the virus. So employers do not expect employees to stay home. Employees want to stay home. The tech industry is probably the leader in remote work, but we'll have to wait and see how this all sorts out, how many people shift jobs, how many do different things. And I think for now, it's hybrid, but we don't know what it's going to be like in the end. And slide 22 just shows you that in our major urban areas, like San Francisco and New York, we've got less than 20% or about 20% of people in the offices. But in Texas and other suburban markets, it's closer to 50%. It's been edging up each week. The virus will determine it, and employees themselves feel they have more power at this point. The final question I'd ask on the economy is house price appreciation. Slide 23 shows you the National Association of Realtors data, which shows this explosion in house prices since COVID. It really started late last spring, early summer. People want more space. They want a single-family house or rent a single-family house, and low interest rates, record low interest rates have made that possible. So this explosion, however, is going to be self-correcting because with prices up this much, even with low interest rates, affordability has been reduced. But this creates a real dilemma for the lending community and for the Fed. And they're just letting it go. And by the way, this has happened worldwide. When you flood the system with money and the rates are low, people actualize on this. So very tricky exit here. So now we'll turn it over to Kelvin for a polling question.
Thanks, Ken. Excuse me. Next polling question. Just as a reminder, you need to answer 3 of these. This is our second one. We'll leave this open for a couple of minutes or a couple of seconds or a brief moment to try to get as high a percent as possible. What property type are you most interested in? The next couple of slides, Ken will go through several of the property types, including some alternative, kind of newer, smaller asset classes. So just curious as to what the audience is looking for information on. And as a reminder, please submit questions that we will get to here shortly. All right, we're about 80+%, so thank you. And here are the results. Looks like a mix of commercial office, other, and then retail and hotels are a little less than 10% each. All right, Ken, moving on to slide 25.
Yeah, thank you, Kelvin. So I'm going to take you through each property type and what we think is happening now and what might happen in the future. So industrial, which is logistics and warehouses, has been the darling of the real estate market. Trade flows to the U.S. have actually increased 18% over a year and a half ago. Initially, when COVID shut down, there was a drop, but it surged back. So unlike previous recessions where we had a sharp drop, we've had a sharp increase in trade flows and imports from Asia, and that's crowded our ports. So we have 2-week waits to get into our ports. People bought a lot of goods with all the money being poured into the system and being able not to buy as many services until recently. And e-commerce, of course, surged. And so it's reduced the demand for physical retail. People are buying directly through Amazon and others from the warehouse. Going forward, we think there's a shift. There's going to be more just-in-case inventories and less just-in-time inventories. It hasn't happened yet. So we're going to have the increased demand for warehouse real estate being accelerated and continuing. A lot of legs here going forward. The vacancy rate's 5% on average. So the best performing sector. Multifamily apartments, we thought these large job losses would lead to people moving back home with their parents, or doubling up, and it did in the high-cost metropolitan areas, high-cost cultural places like San Francisco and New York. They also moved to suburban locations, the mountain states, Sunbelt locations, and so we saw really a K performance in the apartment sector. Coastal metropolitan areas hurt very badly, and the inner locations and suburban locations did quite well. Congress also put a moratorium on evictions in place for non-payment of rent, and this prevented the mass evictions that might have happened. But remember, Congress also gave people a lot of income. These one-time stimulus checks, enhanced unemployment compensation, and so there were some bad actors here where people did not pay their rent who could have. There's $50 billion approved for this. That's a lot of money for landlords and tenants. And the question is, will the back rent, how effectively will it get there, and how much will it prevent evictions? People have left. How does the landlord collect that rent, or can they? There's a lot of problems with the program, but there's a lot of money to make this happen. But there is going to be an end to the eviction moratoriums, I think, in a number of places in July, and certainly others in September, and certainly by year-end. Eviction moratorium is going to be an issue. Office, probably the most uncertainty here because of remote working. I really showed you this already, but I do think that office CBDs especially have an issue. And people say they no longer want to do the commute, no longer want the traffic jams. I want to come in less than full time. So we'll see how that's resolved. Retail, before all this was happening, we had an accelerated, we had a shakeout going on in physical retailing. Malls were hurting. This accelerated this dramatically. Major retailers declared bankruptcy. They've cut their footprints. And so we are going to see rebound as we are now as we reopen, especially experiential retail, restaurants and all that. People want to be out and socialize. They want to shop. But I think the long-run trend towards e-commerce is going to continue, and retailers are going to be under continual long-run pressure. Hotels had a plunge in occupancy as we stopped travel, and especially the international tourist convention and global gateway markets had a huge plunge, and they have not recovered. Just a little bit at this point, but they're still a long way back from full recovery. Overall, though, in the market, excluding those type of hotels, occupancy has recovered about 65% from a low of 21% a year ago. The hotels are recovering. People want to travel. It's all about the virus. So if we go to slide 26, some other product types that I mentioned, single family, just a boom, record low inventories, and house prices are surging. And it really is low interest rates and the millennials' desire to finally become homeowners. Single family rental is an asset class that's here to stay. Normally it's a very fragmented industry, but there's a lot of institutional money flowing in, and people want a single family lifestyle without the financial commitment of homeownership. It's a very tight supply, and that is benefited, that market rent growth is 5 to 7%. Life sciences is the hottest office sector, and you could call it a little more than office, but the surge in funding from venture capital, NIH, for biotech and life science companies, part of it was the race to the vaccine, but I think this COVID demand surge is long-term. There's a tight supply in a few hub markets, but there's also a lot of money flowing in and building. Life science labs are very specialized, very expensive to put in place, but a lot of people want to be there. Senior housing should be doing great, demographic tailwinds, but COVID hotspots were all in senior housing. 45% of all people died were in these senior housing projects. So the occupancy has fallen, demand has fallen, and there's a little bit of oversupply before all this happened. But the active adult sector has continued to do well, not the continuing care sector. We do think that the demographics are great, so I would not discount a big recovery coming here. We move to slide 27, just a few other product types. Obviously, as we did everything remote, data centers surge, demand for digitalization in the economy continues to grow. Mobile home parks, again, have done well before COVID, continue to do well, very supply constrained, very affordable alternative in Sunbelt locations. Self-storage, we had a COVID spike in demand as people moved back with their parents or moved to other locations, and that spike in demand absorbed some of the excess supply that was there. Again, there was a lot of building in that sector. And finally, student housing, the COVID-induced demand weakness as online classes took place is all but over. Almost everyone's returning to classes this fall. Again, vaccine mandates in many cases. And so it's a very good long-term solution for financially squeezed colleges. So I think I'll turn it back to Kelvin for another couple of polling things. Or questions, generally questions, I guess I should say.
Yeah, thanks, Ken. For everybody, we are going to knock out the last two polling questions right now. Please respond. Do you expect potential, Biden tax changes to change your real estate investment strategy? Yes, slightly, no, not applicable. Please respond, and then, right after these next two polling questions, we'll get into Q&A that will go through the end of the hour. So if you have questions, please submit those now, and we'll get to as many of those as we possibly can. So I'll hold this open just a few more minutes or seconds, and all right, the results are coming. 40% yes, 33% slightly, 15%-ish no, and then 12% not applicable. All right. Last polling question. What economic factors have most impacted your business in the last year? A, inflation, B, migration trends, C, cost of access to capital, D, labor changes. Please click the buttons and we can get through this last polling question. As a reminder, you need to answer 3 of the 4 to get CPE credits, along with attending at least 50 minutes of the presentation. All right, a few more moments and we will move on to our Q&A. Just waiting for a couple more. We've been getting to about 82% response rate, assuming the rest are not worried about the CPE requirements. All right, and the results, pretty mixed, with labor changes being the largest impact, followed by inflation and cost of access to capital. All right, we will move on to our Q&A. So Ken, one interesting question here, with a mass amount of inflation to the different asset classes, stock market and real assets, would alternative spending in non-inflationary assets like cryptocurrency start to take over and compete with fiat currency in our economy?
So I'm not a cryptocurrency expert, but I don't think that cryptocurrencies are real. Certainly Bitcoin is not, and Ether is not. So I do think that people are thinking that that's a way to protect yourself, but as you know, Bitcoin has gone from almost nothing to got as high as 60,000. It's back in the 30s or so today. I think they're just relying on a third-party blockchain approach, which is interesting. Blockchain isn't, I think, a real innovation, but I would not move my money into those places. They're not real assets. I would say real assets is a way to protect yourself from inflation. The only time we've had big inflation in the modern era was in the 70s and early 80s, and we got inflation, as you remember, we got the 13% inflation rate, and that is when real estate actually performed really well. So I'd say real assets like real estate make sense. Hard assets, not crypto. I would stay away from that. But my son tells me all the time he would be rich if he hadn't listened to me.
Thank you. A number of questions have popped up around office. In your conversations with people in the market, your clients, and people you're talking to, where do you see office going in the next couple of years? I mean, I personally am a believer that people will come back, as human nature typically does. We've been through other large events, terrorist attacks and smaller pandemics that tell us that metropolitan areas do come back. But I'm curious if you have any thoughts as far as that. Maybe also, what does the future of CBD office look like versus maybe a hub and spoke type model?
Yeah. So we're working on a research paper now called Better Together. My hypothesis is that the corporate culture, the collaboration, the creativity, the mentoring, all works better if we're together at least a substantial amount of time. But we've now interviewed over 40 companies, and I'd say that 80% of them have that same view, and they were going to want their employees back. But some of the tech companies feel that they can run themselves in a remote fashion. So I think that it's very possible that we could see the aggregate office footprint, at least for the near term, pull back. I do think that the hub and spoke model and different geographies are going to benefit. The suburban locations will benefit. People, somehow they commuted an hour and a half each way, and we're happy-ish, sort of. They don't want to do it anymore. A number of people tell me this, and I hear it, and it may be that will prevail. Also, some people have gone to other places and realized that they don't have to be in New York or San Francisco or the CBD, that they can work equally well in Boise, Idaho, Austin, Texas, Salt Lake City, which was already happening before all this took place. So I think there's going to be a structural shift. I do think the comeback, if we can get the cities to and keep the quality of life up. In other words, the key three things are public safety, which is very important. The homeless situation, again, related to that, but really indirectly related, and quality of education. Those are the three things that have to happen. And I still think there's a lot of value in CBDs, but I think there's more questioning of this agglomeration economy in an age where we've learned to Zoom. We've learned the technology allows us to do things that I think, quite frankly, a lot of people didn't know they could do before. So I think the structural shift is open. How big it's going to be, there will be some. And I would say I wouldn't want to pay top dollar for CBD stuff today. I'd want a discount because there is that uncertainty there.
Thank you. Looking through a couple other office type questions, do you see, with less people in the workforce and then any conversations, I mean, at this point, from my perspective, it's hard to determine other than flexibility in the office space as to what we'll have. There's been a densification of office over the last, 10, 15 years. I think that's going to change, but ultimately, at this point, the common theme is we're going to have flexible working environments at the office, and I don't know that there's enough detail out what the office will look like in the future. I'm curious if you've seen anything or heard of anything changing on that front.
Well, we asked that question of the companies we interview. We asked them. At this point, very few are changing any of the physical layout. People seem to want some companies are saying that they're going to have a hoteling strategy, which, as you know, many of accounting firms and consulting firms have had in the past, where you don't have your own desk. You come in and you collect your stuff and you plug into various different locations. But we've also heard about a lot of resistance to that. Employees said, I'm coming in 3 days a week. I want my office and my pictures and privacy. And then, of course, there's the issue of conference space. And if the virus is dead, I think we're going to go back to more traditional stuff than people think, because the virus won't be the excuse. And the question is, how long will that take? And I think that might take longer than we think. There's going to be a rocky transition over the next 6 months, no question.
As we've gone to this working from home, and you talk about, the changes in behavior, e-commerce improving, supply chain disruption, do you see that easing? And if so, when? I mean, obviously, home improvement costs are up, supplies are hard to obtain. We've seen some drastic swings in lumber prices. Just any thoughts around that whole aspect of what we're dealing with?
I think that, let's take lumber, because I think that's important to everyone in the real estate business, especially those building stuff. Lumber has gone from typically about $300 to $1,700. It's back to $624 today. That volatility is unheard of. And what it was is the surge in demand and the inelasticity of new supply of boards. We have no problem with timber. We got plenty of timber, but converting sawmills to boards took a while. They built up the inventory, and then there was a lot of financial speculation in lumber. Remember, commodities traded on the futures market. And so we have all this flood of money looking to try to make extra money, and that really, I think, exacerbated this phenomena. But I think construction costs, as I look at it, are up 10 to 15%, depending on where you are. Lumber is just a part of it. Labor shortages are a big part of it. Other materials as well. So I don't think those come back, go negative, but I do think they could slow down as we get the new supply of materials coming back. Labor is a tricky one. A lot of people left the industry, and how do we get them back? So it's a tricky one, but I think labor costs generally, we have a shortage of labor in the non-remote working area. And I think it's going to be a while before that resolves itself. We need training programs, a whole bunch of things. And to think that this inflation disappears, which is what the Biden administration and the Fed say, is just happy talk. They're wrong. It's not going to disappear. It will slow down, but it's not going to disappear. We've had a structural shift, and I'm really disappointed that they haven't taken it a little bit more seriously, and they could do things about it.
On the labor front, obviously, we've got migration. You mentioned in the presentation that 45% of population growth has come from immigration that basically stopped. Are you seeing or hearing, or what could we do to try to improve that, or do you see changes coming that potentially could help with some of this labor shortage?
Well, we definitely need a bipartisan immigration reform bill. We had it all but done under the Bush administration, Bush 2, and it was Democrats and Republicans that came together. We need to reform the system, but we should give a green card to every offshore student in the STEM area. We want them to stay here and make our industries grow. And of course, we all know that Silicon Valley, it's really those legal immigrants who have made it grow dramatically over time. So it's a good thing. Our cities need this source of population growth. And so we need to reform the system. We need to get that all right. I think the Biden administration understands this. They're moving in the right direction, but it takes a while to change things. And the COVID travel restrictions are still in place. So the offshore students have trouble getting here. And a number of places have quarantines and other things. So until we get the virus solved, I think it's going to lag behind. But we need to do that. And I'd say the urgency coming out of the administration on this is not as great as I would say. This should be their emphasis, not raising taxes on everyone. This should be number one emphasis. How do we get the labor force not only employed here, but bring back those 1 million people a year legally who would come to the U.S.
And with the amount of funding that's gone into and labor shortages, are you seeing any data yet that supports an increase in labor costs coming our way as just more inflation and,
Yes.
and challenges?
Sure. So low-end service inflation, labor costs are there. I think the latest numbers I saw, 6% year over year. So it's definitely happening, shows up in the data. Overall, wage inflation is probably about 3.5%, but I think it's probably underreported the way the government calculates it. So there's no question it's happening. Also, add into the fact that we raised minimum wages in a number of states as well. So, and this labor shortage, by the way, isn't going to just disappear. It's here for the longer period of time because of the aging population. People are retiring, and we don't have enough new people coming in domestically. We're going to have to import more people here if we don't want a wage price spiral. Again, not an emphasis of the administration, but needs to be. And maybe it's our fault as economists for not raising this issue, but every business I talk to, attracting people is the number one thing. You saw the record level of job openings, and maybe it's not matching people in the right place. Maybe it's too much money in people's pockets and they're waiting, but it's also fear of the virus and reconsidering their life choices. The article after article appears about this.
What impact do you think these infrastructure plans and new policy will have on that as well? Is it just going to make the problem worse?
I think if you look at the infrastructure plan, the bipartisan one, it's really about $550 billion, and it's spread out over a longer period of time. So I think there should be a labor training component of it, bringing especially people who are not in the labor force, younger people who need jobs. I think they should do that. I don't think that's the one I'm worried about. It's the additional $3 trillion that is proposed by Bernie Sanders and friends, and they basically want to make it so it is more profitable and really less needing to work. And I know that people struggle with 2 jobs and all of that, and that is true. But the idea that providing such a big foundational support, so if you have get these permanent income transfers, it's going to cut work. It's going to cut people's ability and desire to work. And I know that sounds funny, but all economic research shows that that's true. So I am very, very worried about some of those things. I don't think they're going to get this stuff through. Requires all 50 Democratic senators to say yes, and I just don't think they're there. But it's very possible. But the impact of these federal programs on work should be studied in more detail before we, again, put some of these massive amounts of money in people's pockets.
So a number of questions surrounding residential, single-family home markets. Obviously, it's unprecedented, the increase in housing prices over the last year and a half. I know talking to some of our developer clients, during COVID, it went from we may not even hit projections to, oh, no, how are we going to supply all of this that we think we could do? So where do you see, do you forecast where you think pricing is going to go? I mean, are we going to continue to see this significant inflation?
So I do think that we're, with the house price increase we've seen, and even with these low mortgage rate, affordability has been reduced. So some of the excess demand was because prices were relatively stable, and we had interest rates so low. But now that prices are up, if you take the 2 years, are up 30% and 40% some places, that's going to curtail demand pretty quickly. And I think there's still a backlog of demand there, but I do think that as interest rates normalize, and our view is interest rates on the 10-year bond will go back to 3%, which means that mortgage rate goes back to 4 from under 3 today. I think you're going to see reduce demand over time. But remember, the demographics are very positive for for-sale housing because the baby boomers' children, the millennials, are returning to the market in a big way, and they're stretching. So I do think that near term, still very strong, but I think medium term, the affordability prices will push people, not let people do what they've been able to do. It also means that that we are going to have to possibly have some first-time home buyer initiatives out of Washington. There was some talk of that, but not there at the moment.
You know, on the single family, you got the single family for rent and then the development for rent. Obviously, there's a ton of capital going into that. You're starting to hear of master plan communities that will just be rental only. Do you think that's going to cause any longer term? I mean, we're 10 plus years into the single family rental market and it seems to be stabilizing and here to stay. You know, I think speculation 10 years ago was we'll wait and see. But it just continues to mark up. I guess that gets back to your demographics comment of the demographics are good.
I think that the industry has been, as you know, a mom and pop industry. There are a lot of single family rentals owned by three or four houses. So institutionalizing this, managing it with technology, building basically rental communities that are horizontal rather than vertical, I think meets a demand in the marketplace for people who don't have the wherewithal to buy or don't want to have the commitment of a mortgage. So I think it's here, but we certainly could see pockets of overbuilding if we have these billions and billions of dollars of capital. So I'd say a lot of market research here. Build to rent is really hot, and there just seems to be a lot of demand for that type of phenomena. But it is basically people who their first choice would be to buy if they could qualify, I think. But some people are worried about taking on a mortgage and the like. So I think there's a backlog of demand here, but overbuilding is something we're really good at doing in real estate. We've done it in the past. The last time we did it in a major way was obviously in the housing market in 2008, 9, and 10 from earlier period, and of course in commercial real estate in the early 90s. We're good at doing this. We can develop. We're good at this industry.
So, last question. Taking everything into account, the pandemic, change in administration, new policies coming our way, looking at U.S. real estate from a global perspective, I mean, I believe it is, but do you still see it as being a strong asset class, maybe a safe haven for capital in the near future?
I have no question that people who can get on a stabilized property a 4% yield, it looks really good in the world where Treasury bonds are 1.4. They're negative in Europe and Japan. So yield looks good, but don't be. I think a lot of people are betting on double-digit returns and lots of appreciation. That happens in spurts, and I think you shouldn't bet on that. And there's question about certain categories of retail and office CBD spaces. Enough questions that you've got to be selective. It's a time to be very selective. Like a stock picking market, it's a real estate market and product type picking market. You can't invest in the index because that would, I think, or in specific markets that are going to have issues. So it's capital flow is going to continue, no question about it. The world is awash in money. I think that's probably the big important theme to tell everyone here. It's awash in money. So I look at it as if I'm in the real estate business, I want to get a big basket and get as much of that money now as I can, because I'm certain that 2 or 3 years from now, that money will nowhere near be as plentiful and as cheap.
All right, we're running out of time. Thanks, Ken, and thank you everyone for joining us today. Before we close, I'd like to make you aware of some upcoming business insights that will be available soon. Starting in August, we'll be hosting a business transition series that is comprised of 3 webcasts. Industry experts will cover various topics and considerations around transition. In October, we'll be hosting our annual Building Opportunities Conference. It's a virtual conference. We'll feature leading economists, including Ken again. We'll get an update in October of where things are again. Futurist keynote speakers, etc. Again, CPE will be offered. So stay tuned with that. And with that, I'm going to pass it back to Amy.
All right. Thank you, Kelvin. And thank you, Ken, for providing us with all of this information. And for our attendees, if you met all CPE requirements, your certificate is available to download now in the CPE progress window. I will keep the webcast console open for a few minutes to give you time to download. And we will be emailing out a copy as well if you have any difficulty downloading it now. And for those that would like a copy of today's slides, you can download those now as well from the slide deck and handouts window. And we will also be sending those out along with a recording of the webcast tomorrow. And here is a link to an online survey for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. And thank you all for joining our webcast. We hope you'll join us again next time.